The reason a stock would fall on good news doesn't actually have anything to do with the news. It actually has everything to do with how institutions make their money. It has everything to do with the prior positioning of institutions, and it has everything to do with retail reactions. Institutions don't actually care about the news. They only care about taking the money from liquidity pockets that retailers provide. If news comes out and it's good, retailers will perceive it as good, purchase the stock, as institutions use this liquidity pool to sell. They already own the shares for cheap. They already know the stock is a buy. They're going to sell into this buying pressure, drive the price down, and buy it again for cheaper. It's a very smart strategy, and it will come from someone that's playing the game 2 steps ahead of the retail crowd. Retailers being me and you. Retailers being the crowd. Institutions always make their money from grabbing pockets of money that are created by retailers. This can be created through news events. This is why a stock will fall on good news. A stock will rip on good news or go higher if an institution wasn't previously positioned. If surprise news comes out that's super good and an institution didn't already have a position in there, they will immediately aggressively purchase. It will cause the stock to rip. That's when a stock will rip on good news. A stock will fall on good news when they decide to sell into the optimism. That is how institutions make their money. A stock will fall on good news when they sell into the optimism, and a stock will rise on good news when they buy into the pessimism. So they don't care about the news. They simply care about the reactions that retailers provide. So big money has no position before the news. They're going to buy the rip. If big money is long already before the news, they're going to either sell the rip or buy the dip. That's exactly the reason as to why stocks fall on good news. So technically, good news is a buy. Think about what an investor looks for. An investor looks for a company that has so high demand that the supply can't outweigh it, so they need investors. The company turns over so much money that they can pay their investors back. That's exactly what companies look for. So good news is good news. Technically, a good news is a buy signal, but short-term moves will trick retailers. Now, if you want to get a little bit more advanced and consider before taking a position, big money is selling puts. That means a bounce is coming. If market makers are the ones that are selling the puts to you, that just means they're doing their job, and bears could be correct. So if big money is driving the price of a stock down by selling into the optimism, and they're going to buy it again for cheaper, they might be selling large put positions. That means that they're still exposed to long, and they're still building a position to make money on the upside. That's how you can understand how not to be milked like a retailer even when news comes out and a stock falls when the news is good. And you could really critically think about what's going on. To somebody that's 2 steps ahead, this is obvious. I hope that you learned something from this video. This is the whiteboard without me standing in front of it. If you did learn something from this, please subscribe. Thank you.